6 or 7 of the really important countries probably in a recession. The UK in really big trouble. The US relatively keeping things, in a pretty good place. China economically, I don't know where the demand is going to come from. On the same time that their internal demand is imploding, they're creating all these export controls that I think are not going to actually help them solve the problem, because it just accelerates Western economies' desire to delever from China. So the whole setup, I think, is very complicated one, but the U.S. looks really good, frankly. And,
well, yeah, look, I don't think we're out of the woods quite yet. So Druckenmiller, by the way, said that he was predicting a hard landing in the second half of the year. We're just starting the second half of the year. So he's still got 6 months to be proven correct. I find his analysis compelling, or I did at the time I heard it. But think about our situation. We still have an inverted yield curve. It's the most inverted it's been. I think this is the longest it's been inverted. Now the Fed is signaling that we're going to get 2 or 3 more quarter point rate hikes. So it's about to become even more inverted. And what that does is it puts incredible pressure on the banking system, because the whole banking business model is to borrow short, which is from depositors, and lend long. And if short rates are higher than long rates, that whole business model doesn't work. So either they can't engage in lending activities, meaning there's a credit crunch, or deposits just leave the system. And that's happening too. So any business out there that's dependent on credit, the real estate industry or auto industry, I mean, any industry that depends on loans and credit, they're going to continue to be hammered by this. So
yeah, I mean, to your point,
Go ahead.
Sachs, I'll just read the minute commentary on this. The meeting did include a discussion on the stress on the banking sector and economic activity in general because of decreased lending. Participants generally noted that banking stresses had receded and conditions in the banking sector were much improved since March. Participants generally continue to judge that a tightening in credit conditions spurred by banking sector stress earlier in the year would likely weigh further on economic activity, but the extent remained uncertain. So obviously a wait and see. And that they mentioned that credit conditions had not appeared to have tightened significantly beyond what would be expected in response to the monetary policy actions taken since early last year. So at this point, saying it's a wait and see does not seem to have overstretched in terms of credit tightening at this stage, but it could.
Yeah, I mean, so here's the thing, is that the Fed engaged in an extraordinary intervention a few months ago to save the banking system with the Bank Term Funding Program, right? Where they basically said to all the banks that if you have US Treasuries, and I think it also applied to mortgage-backed securities as well, we will basically take all of those assets and give you par value. We'll give you 100 cents on the dollar.
Yeah.
In exchange for, I guess you have to pay, the bank would have to pay the 1 year, I think it was the 12-month interest rate with like 10 basis points or something like that. So if you're sitting on bonds that have gone down 20 or 30% in value, you can go get all that money back by, presenting them to the Fed.
Mm-hmm.
And then you just have to, you have to then take the 100 cents on the dollar you get and make sure you loan it out at higher than the 1 year interest rate, which is around, I guess, 5%.
Right.
Which you can still do in residential, right? Because mortgages are still something like they're over 7%. So the Fed has provided a lot of liquidity to the banks through this BTFP. It hasn't helped the commercial real estate guys, I don't think. That's why there's still, I think, huge problems in the commercial real estate sector. But the Fed did engage in a huge intervention to save the banking system, and they may not be done with that yet.
You guys,
so I just wonder,
yeah.
I just wonder if you didn't have all of these distortions, what would the real shape of the economy be? Another one on the fiscal side, on the fiscal side was the whole Biden's energy bill, which was supposed to be $350 billion. But as our energy investor friends are saying, it's probably going to be more like $1 trillion when they add it all up.
No, but that's honestly, hold on. Those guys are being hyperbolic, and they're just stupid and wrong, because I know which friends they are, and I know them to be mostly stupid and mostly wrong most of the time. Look, the good thing to know about,
oh my God, I'm gonna get a text after this.
Well, yeah, you should, because he
Yeah.
doesn't know what the fuck he's talking about, and he keeps saying
But
it.
there's
He's
a
just
lot of
making it up.
stimulus is the point. Whether it's half a trillion or a trillion.
Whatever.
Half
He's
a
just,
lot of
trillion.
stimulus.
he's just talking his book. But where can I just go back to where you're fundamentally right, and where I think both of us can be in unison on this, which is there is a looming credit crisis in the United States. And you know, we've talked about this before. I tweeted something a few weeks ago, but the debt wall that corporate America is about to hit is pretty meaningful. And to your point, David, a lot of these companies will have to thread a needle, because if rates don't go down materially in the next 18 to 24 months, these folks are going to be paying rates that they cannot bear. And they'll probably go into still breach a covenant of some of the debt. So, you know, one thing that's important here is that there's some very strict guidelines and covenants that debt issuers sign up for. And one of them is, you know, how much debt can I have as a percentage or as a multiple of my EBITDA? And so that's the way that bondholders govern the risk that you don't overborrow. Now, the problem is if you have a ratings, you know, an earnings recession and or rates go up, you can get one of these two things to go wrong. And all of a sudden now you have 7 or 8 times your EBITDA and you're in a very, very bad state. So I do think that that's possible. But at the same time, I don't think that that's a calamity that touches the entire economy. I think there are a whole portfolio of over-levered companies in real estate, and there's a whole portfolio of over-levered companies in private equity. Those folks will have to get recapped, and that will probably cost trillions of dollars of capital impairment. But I do think that that can relatively be done without impairing the economy writ large.
I'll make a prediction right now. My prediction is the federal government is going to help to monetize that debt, and they're going to help to support that commercial real estate sector through some sort of structured lending program. I don't see
Why do you think that? Why do you think that?
Because of the donors. Because I think that there's a significant amount of capital that gets donated to
So you think
political
there's going to be a
campaigns that come from-
TARP-like program?
for real estate private equity, a real
Do you
estate
think
private
there's
equity
going
and
to be
debt.
TARP? No, you think there's going to be a TARP-like program for real estate assets and for private? I'll take the other side of that.
Yeah, I'll say
I
real
would
estate
say-
assets. I don't know about the private equity assets, but I think for the real estate assets, just because so much of it is held.
Let's bet.
and
let's
I'll
bet
tell you-
5,000 to the SPCA.
Yeah, I'll do that.
Okay.
Wait, what's the time frame? Maybe.
Well, you tell me. You want
Well,
infinite?
No, we'll do it until the Fed starts. No, until the Fed starts reducing rates. So once the Fed does their first rate cut, that's the end of our bet.
Oh wow, that's an easy one. I'm in. I'm in for 25.
No, you,
Yeah,
you
I'd
can
take
take 5.
100. I'd take 100.
Okay.
For
For the
can I take it for
SPCA.
myself?
For the
Forget the
SPCA.
SPCA for a second. Can I just
No,
take the
come
action
on.
for myself?
I'm doing
mean,
it for
the
the
reason
dogs.
for-
I'm doing it for the dogs.
You know, Friedberg on that. I mean,
Sorry,
the-
let me just tell you why. Sorry.
Okay.
In addition to the significant donor dollars that come from real estate to politicians campaigns, but so much of those assets, so many of those assets are held in life insurance companies, on banks' balance sheets. I mean, you guys may have seen this report this week that because of the rise in interest rates, there are several insurance companies that now may be technically insolvent, according to DOI, Department of Insurance regs, in their respective states, because the impairment on the bond portfolio has declined, has caused them to now not have enough capital reserves to pay out the claims they have. So the same, I think, ultimately will come true once you have to do a mark to market on all these real estate assets, that there's a significant number of those real estate assets that are held in pension funds, that are held in life insurance companies, that are held as securities in large pools of capital that are meant to support people's long-term needs. And the government isn't going to let, the federal government isn't going to let that, just get written down and have people's future pensions or insurance claims, get hampered. So that's why I think there's going to be a moment or two where there's going to be some step in and some structured program to support this debt.
I just don't think it's that draconian. Rates are not that high.
Yeah.
You know, we're still talking about a 10-year that's flirting with 4%. And the fact
I'm
of the
just
matter
talking
is-
about commercial real estate because there's also
know,
a demand problem, right? Yeah.
I know, but the other side of this is the trend. Again, there is no doubt oversupply and a problem, particularly in a place like San Francisco, where we're going to see some blowups because nobody wants to, to enter a long-term lease in a city that's under siege.
Right.
I understand that. But the fact is that the market is telling you that rates are going to start going down, right? That the Fed's going to come in, battle until the edge, right? And then they're going, Feds are going to come, rates are going to come down a little bit. Why is that? Because if they have 2 more quarter point rate increases, now you have restrictive rates at something like 200 basis points. That's higher than the Fed wants.